like to welcome everyone to our first RankiaPro Portfolio Shifts within Fund Selection and Fund Management webinar. I would like to welcome everyone as we have Christophe Jaubert and Betrand Rocher with us here today to have this call in this afternoon. My name is Liliana Verona and I'm the Investor Relations Manager of RankiaPro, and I welcome everyone. So as a start, I would like to introduce our two exponents today. We have Christophe, who is the Chief Investment Officer at Mediolanum Irish Operations. He started working in Mediolanum in 2018 as Head of Investments, and he previously worked at Rothschild & Co. And we also have Betrand, who is Senior Credit Analyst at Mirova. Previously, he worked at Natixis Asset Management, and on the side, he also works as a professor at Sciences Pro. And do you want to introduce yourself further, Christophe and Betrand?
Yeah, maybe quickly. So I have started in '94 the job of investing and into multi-management side. So I have in '94, it's much more than 25 years of experience, both allocating money, selecting managers, and combining different manager, different strategy in order to deliver interesting and attractive return for risk-adjusted return for our clients. And I'm happy to have joined Mediolanum a bit more than 2 years ago, 2.5 years ago exactly. And we're managing 40 billion here from Dublin for clients based in Spain, but as well in Italy, in delivering a lot of different profile of portfolios from cash and obviously fixed income up to equity, like emerging market equity. So we have a broad range of opportunity set for clients.
Okay. Thank you so much, Betrand. Yes.
I would just add a word, not to introduce myself. It was perfect, the introduction you made of me, but just to present or introduce Mirova. It's an asset manager which is part of Natixis Investment Managers and which is 100% dedicated to ESG and SRI. So we only have fixed income funds, equity funds, or management funds only dedicated to SRI green with a lot of impact if we can add this to our clientele. And our clients are based in North America and across Europe mainly. And that will be it for Mirova.
Thank you so much. And then I would like to kickstart the conference call. First of all, we would like to have a couple of warm-up questions in a form of a debate to talk about how did COVID-19 affected the day-to-day life of both of you as both sides of the spectrum. If you could shed some light on how things became different day by day, and if you see any inclination that we are going back to normality anytime soon.
Yeah, I can start maybe. So Betrand is based in Paris. I'm based in Dublin, so you will have
yes, two different views.
View of European cities. So here in Dublin, we have 25% of the workforce in the office. The rest is remotely working still. Advised, the government here is advising to work still from home, but we progressively rotate within the organization in order to go back as quickly as possible in a normal way. But I have to admit that we were very well organized in order to jump very quickly into a remote approach, and the test live was a big success, and obviously we learned to work a bit differently. What has changed as well is that we in that kind of event we were very much close to a manager that we delegate assets to, in order to make sure that they are on their side as well managing well this very specific and peculiar situation. And to give you an indication, for example, last year we had a 600 interaction with a manager that we selected, or the research of manager that we want to select. And when I say 600 interaction, it's interaction more than 1 hour. It's just a 5-minute call. And just this year, as a comparison to that, we already did 400 of this interaction of more 1 hour, and using a lot of obviously video conference to do that. But just to give you this indication, it's a third increase versus the last year, the same period of interaction with manager in order to be on top of everything.
Okay.
How are the things in Paris?
Things are great in Paris. This was a very great period from a personal point of view, finally speaking. But you have to know one thing, was that at Mirova, we work from home very usually. It's a standard here. So it has not changed a lot of things in the way we work, because we are already used to doing like that on a day-to-day basis. What was more difficult, maybe, to be less enthusiastic than Christophe, is the interaction with issuers. At Mirova, we like to know the companies in which we invest, and we meet with them, especially the issuers of green bonds. And I must admit that doing it by mail or webcam and these kind of things was maybe less friendly. For the rest, it was okay. And what was nice also from a pure asset management point of view, it was leading us to coordinate more our asset management. So all the portfolio manager spent finally more time by phone and so on to coordinate and implement the same views. So that was a great experimentation for us at Mirova.
Oh, thank you guys for both of the insights. It's very interesting to see how everyone is dealing with the same situation kind of differently. My next question would be on a little bit of an economic perspective and an outlook. As you guys can see and the assistants can see on the screen, we have a World Economic Outlook update from the International Monetary Fund, and we see 3 different perspectives. We see a global economy, we see an advanced economy, and we see an emerging market and developing economies. As we can see, the most affected was the one that has -8% on an advanced economy level. Christophe, do you want to add some comments on this, or your opinion, take on concerns with this uncertainty?
Yes, thank you. Obviously, the way we see the world, we were entering in this situation of a COVID crisis on this slightly defensive mode, but it was not that we were forecasting anything about COVID. It was just that we found after a very good year in 2019, we wanted to have a slightly cautious stance into our portfolio. So that was a good starting point. We didn't dare to go back full risk on the 23rd of March. We would have liked to do that, but I think we wanted to stay slightly defensive and more than defensive, a bit more on the quality side of things, because we think that first of all, the COVID situation, even though we've seen a lot of area where it's getting under control, but it's still maybe early days. We see in China seems to work quite well. Some other place less well, in the US, obviously, as everybody knows. So that's only the first wave of things.
Yes.
Not get rid of the first wave. So let's imagine a second wave in October, November, December. It's going to be potentially more damaging as well. So definitely, we are convinced that we're going to manage that at the end, either through herd immunity or through a vaccine. And we've seen some good news, around 45 participants yesterday. So it's very, very early days before getting something else. So, but we think that if we take a long-term perspective, a lot of money has been sent into this situation, and much more than what it was in 2008, for example. So that's obviously a positive. The big question is when the subsidies will stop, and probably it's not for July, August. We are convinced that the government will continue to pay the premium in a way for insurance of the global economy and their own economy to be back on track as soon as possible. But we still think that there will be some damage, and we will see that probably in the next 6 to 12 months. And that's the main issue that we have in this current situation. The news will be good. There will be a rebound very quickly, but how much of this? Today, 80% of the US unemployment are temporary. That's how it is described now, but we don't know really in 3-6 months if this 80% will really be 80% or if it's 60-70%. So I will characterize the situation as still quite a lot of uncertainty around the environment, the macroeconomic side. We are, as I said, still just very slightly cautious in order to be exposed in this momentum that we see in the market, because we see with the yield where they are on the market, the equity market is flying in a way. So we want to benefit from that, but we are very monitoring that very carefully in order to adjust the portfolio if needed.
I would add something, but maybe at Mirova we have a tendency to split, the advanced economies in two parts. On one hand, we would say that Europe is a case, and on the other hand, the United States will behave pretty differently from Europe. This is how we see things, so we would not back Europe and the United States and Japan as advanced economies, because this is not enabling us to describe two phenomena that are pretty different. Christophe talked a little bit about it, but we tend to consider that the US economy might, and we will talk about it in a few minutes, I presume, but the US economy have the means with which to bounce back much more rapidly than Europe. And finally, Europe is more protective, of course, from a social standpoint, but we think the price will be delayed over the coming months. As Christophe said, there's no doubt about it. So we notice that. The second thing we can also mention is the great resilience we have seen in Africa. Paradoxically, some were very worried about what could happen to Africa and the African people. But finally, the Black continent has pretty much resisted, admittedly from a very informal economy. But that's interesting because this economy, this continent, will be key in the several decades. So we can consider that the COVID-19 to some extent was a sort of a test to what is being put in place in the future after all the organizations like the United Nations, for example, try to make people aware of, i.e. global warming and these kind of things. And finally, we have had a test over the past 3 months on how economies would react to the long-term trend in a world that is trying to adapt to a low-carbon economy. So these are the two things maybe I would like to insist on.
That's very insightful, and thank you so much. I'm sure that in the end we will have some questions about these views on splitting the US and Europe into these such different categories. And getting back to your point on US, as you also mentioned and Christophe mentioned, these are all possible risks that economy and European and both US economies had to face. And you mentioned that the US elections could also have some serious impact on economy. Do you see, Bertrand, that the US elections can have any direct implications on Europe, and what's your view on this?
Paradoxically, we consider that what's happening in the US from a political point of view is in place for years now. Let's say back to the presidency of Mr. Barack Obama, and that be it Joe Biden or Mr. Trump, finally the long-term trend in the US politicals and geopoliticals will not really change. So we are not that worried at Mirova by the impact of one being elected rather than the other, because we think that anyway the USA are little by little leaving Europe to some extent and entering into a long-term, not fight, but competition with Asian economy, not only China, all the Asian economy. And that is a trend that we do not see as being affected by the next election. Once again, it could be seen as very paradoxical because I know that some of our competitors do not think the same way, but at the very least, this is the way we see it at Mirova. We consider the long-term trends are more important than this election, especially since that you all know that in the US, well, the political system is made in a way that finally can grab power away from the US presidency, from the White House, if the Senate or the House of Representatives do not share the same color as the man in the White House. So this is our view on what will happen in November, and then after in 2021 when the new mandate of the new president of the United States starts.
Christophe, do you have any similar or opposite views on this?
It's true that I was mentioning that on the geopolitical front, the US is focusing more on their internal subjects, where it was maybe a bit more concerned by external subjects in the past. Maybe with a Democrat, it will change a bit, then at least equilibrate a bit more. But I will say that it's maybe again a chance for Europe to put themselves together and try to be a third force with China in one side, US the other side, and it's probably the only chance that Europe can compete with this two big force. So that's the chance I hope that Europe will take, and we will see, for example, at the end of this week, if they're doing a first step with a recovery fund and getting all together and admitting that they have to give some money and not loan to some situations of states that are in more difficulties and showing solidarity. So we will see on that side. On the US election, we are, if we discuss about more market, we are, of course, we are still a few more months before November. So, but if you look at the betting markets, everything indicates that Trump is losing, and it's even that on the White House, on the Senate, but as well in the House. So which is as of today quite significant. It's probably too early days to say, but we are a bit surprised that the market now is probably not too concerned by that, but it will show up in volatility definitely, at least in September or somewhere around that date. We will see the market starting to focus on that, because it will have some implication for different things. But we tend to say that over the long term, again, back to Betrand, and we have at Mediolanum a long-term approach, because that's the way we think retail and clients' money should be managed. We think that this kind of election doesn't have that much impact over the long term. The US is still an entrepreneurial country where they are quick to react to any new situation, and that's the most flexible economy, probably with China today.
Yes, I completely agree. So thank you both on these couple of debate-like questions and on some general market views. Now we would jump into the second section of the conference call, where each of our presenters will present their own topics. And we are going to start with Christophe's part. and he's going to shed some light on some challenges within fund selection. And also, I believe that the presentation regarding equities markets is going to be very insightful. I just want to say that for any attendees, if they would have some questions regarding Christophe's presentation, please feel free to leave it in the chat box, and in the end, in the Q&A section, we will make sure that we have time to review these questions. And Christophe, I will give the word to you. And yes.
Yep, thank you. Thank you, Liliana. Yeah, we always ask ourselves, as I mentioned earlier, we invest for the very long term because that's the way we think it's the best way to create some wealth for clients in their financial assets. And we always question where are the most interesting opportunities, and taking as well a long-term view. And one opportunity that I wanted to discuss today is the influence of demographic elements into financial assets, and in particular where we see opportunity in the equity market attached to this theme. So on that graph, you see some kind of key macro trends about demographics. And on the first slide on the left side, what we call the world support ratio, thanks to a graph generated by BCA, the Bank Credit Analyst research, which shows the how does the world support ratio was, which is the number of workers relative to the number of consumers. So we see that late 60s, 70s, that trend was going down. So there was more less workers than consumer, and it's reverse in the 70s up to most recently, where we reach a peak of that number, which means that when it's going up, there is more wealth to be invested, more wealth to be invested in financial markets, and creates a lot of different impact and a lot of different financial assets. For example, the neutral fixed income, neutral interest rates level will be much lower in this kind of environment. We are entering in a very different environment, which is a very long trend, which we need to take into account into our investment policy. And on the right side, you have an illustration as well of how much, and that's the dotted line green, which is the amount spent when you are in different bracket of age, but you can see that you are spending more money the older you are. And that's as well another trend that is structural, and that's is interesting to take into account. So if you move to the next slide, about where we see opportunity in the global demographic equity opportunity, we see three key area: the silver economy, the new consumer, and the population growth. So silver economy, where obviously the world is getting older, the consumer aged over 60 years old will be spending something like $15 trillion this year, and that's something very significant. And obviously behind that you have the healthcare part, the financial part, and the discretionary part. The healthcare part is linked to the aging population, obviously the pharma, biotech, medtech, the care and support that is very important for that part of the economy. The financial is life and health insurance, the wealth management, pension, financial innovation as well. And on the discretionary, it's a lifestyle and wellness, food, exercise, travel, beauty and image. And if you on the new consumer side, it will be the element of e-commerce, sharing economy, for example, or entertainment, and that's all the kind of cashless payments, fintech, e-commerce, but as well on the sharing economy. You are well aware of all these different company exposed to that, and on the entertainment, the gaming, the which obviously with COVID have been very much exposed to. And this principle of people, this kind of generation, don't want to own stuff, but they want to experience what it fulfills more than owning things. And that's creates a big change in the economy as well. And the last big theme, which is a very significant element to that, is the population growth. And the population growth is very varied depending on the area. Bertrand mentioned Africa, obviously, where the natality there is very high versus developed market where it's very low, and create a lot of different issues, a lot of different opportunities as well, which is interesting. And one side, the increase of urbanization, the EM consumption, which is increasing, and the other one, the resource scarcity that obviously is linked as well to ESG. So if you move to maybe next slide. Yeah, so to take benefit of this opportunity, I wanted to highlight one manager that we like, and I know that we wanted to present it. One manager, and that's the manager is the one that we use today as a manager investing in global equities, but with a tilt toward demographic thematic. And that manager is Schroders. And so why Schroders? Schroders, they have 30 years of track record. The manager, the CIO, is Alex Teder, that we know from quite a very long time in his previous firm where he was managing US equity. Today he's a CIO of Schroders on global equity. They have a specific proprietary demographic database, which is obviously a key element there to determine, identify some trends and some interesting opportunities. Their active shares is quite high as well, 90%, which obviously is a key element as well. And they are something quite unique as well is they provide an exposure to all market cap, being small, mid, and large cap. And not only focus on one segment of the market. So in terms of performance of that team, I didn't want to show any performance track record, that kind of things, but just to highlight one thing is this CIO obviously has a team, and the team is organized of six PM portfolio manager specialized around global equities and different thematic there, but also we used a global sector specialist team of almost 12 people dedicated to that. In terms of performance over the long term, if we look at this, the performance of that manager in different type of mandates around global equities, it outperformed the market by 33%, depending on the different benchmark it was compared to. And if we compare to the peers group, it's around 20%. So you can see quite interesting outperformance over long term of that manager. If you go to maybe the next slide about showing maybe some ideas, but before that I will highlight the fact that the split between the three, a big proportion will be linked to population growth thematic, which represent on average 50% plus. Then the new consumer will be around a third, and around a bit more than 20% silver economy. And in terms of region, you still have a significant part on the US, in particular for the technology part of things. But emerging market is significant because it's 21%, Europe around 20% as well. So in a portfolio exposure like a demographic theme, you will have some, obviously, some bias included there. First of all, one bias will be a growth element. You will have a tendency to be slightly more growthy than the blend type of portfolio. You will have also an over-representation to some sectors like consumer discretionary, as well consumer staples, financials, and healthcare. And you will be very little exposed in general to sectors like energy and utilities for the obvious reason linked to the thematic of that portfolio. Here you have some names and some stocks, so I won't go in great detail there, but it's a good illustration of the variety of companies and a variety of the drivers which provide, even though it's a thematic funds, you will have a lot of variety of factor of risk, of factor of performance, factor of exposure in terms of region, in terms of type of clients that will provide you with a lot of diversification and a good complementation for a global equity portfolio. So that's the way we position that kind of opportunity into a global portfolio for clients to have a long-term exposure to a long trend and significant trend in their portfolio in order to deliver interesting return.
Thank you, Christophe. This was very insightful, and I believe all of these three themes that you described could be very insightful. I would like to pass on the word to Bertrand, who's going to talk us about a little bit of the other side of the spectrum as a fund manager and as in fund management in general. Do you want to start by just explaining a little bit to us, to our audience about fixed income active management and the Mirova fund?
Thank you. This is one of Mirova fund on this slide. I tried to illustrate for RankiaPro the thematics of active management. At Mirova, we really believe in active management. The first point is that we do think we are going through an environmental transition, which is an economical transition. This is the same thing being said in a different way. And when there's such a transition, the rules of the game in the asset management or in the way you cherry pick your stocks or bonds are a little bit changing. It's like at the end of the 19th century, for example, when the industrial revolution were running at full stream all over Europe and not only in the UK. So in this kind of periods, you need to think and really have a fundamental approach. The second, let's say, lever for going or opting for active management is the liquidity. At the end of 2018, for example, we have observed, like our competitors, that liquidity was all of a sudden vanishing. And in this kind of period, if you want to build up or to reverse a position, if liquidity is vanishing, it means it takes a lot of time to change your views on the portfolio. And by being active, it means that you have the time to anticipate things and not to adapt to them once it's too late. The second very important point is that when liquidity vanishes, well, if you want to sell a paper, you have to do it by sacrificing 2 to 4 figures. This is the kind of problems we could have observed at the beginning of March 2020, for example, and when everything was really panicking. So active management for us, it means being able to really change our position brutally if we can, or more slowly if liquidity doesn't or prevents us from being more brutal. But at the very least, when you are in such a transitional period, you need active management. This is the way we see things. And in this graph, it's just an illustration, is to show you how, for example, we underweight sovereigns in our aggregate strategy. This is a strategy I do not manage myself. This is one of my colleagues. And you can also observe, for example, the weight of credit. We decided to increase the weight of credit. I will come back on that later on. If we can go to the next slide, or even that after the next one, this is also an illustration of how we go for duration and modified contributed duration. Regarding the shift in portfolios, I have put this slide because we did three things in mid-March at Mirova in our fixed income funds. The first one is to increase the weight of credit. The second one is to increase our exposure to cyclicals, which we were underweighting before. And the third one is to increase our exposure to the US economy. Christophe and I talked about it a few minutes ago. We considered at Mirova that, well, finally, the US economy will bounce back much more rapidly than in Europe. And we decided, this is something that is being illustrated by this graph, showing the positiveness of positive surprise in the US. You can see the dark blue line, it's much higher than the rest. And this is something we try to implement starting mid to end March 2020. Why so? For credit, we considered that central banks would have no choice but to help global economy, be it the Bank of Japan, Bank of England, or the Fed of the ECB. No doubt about it for us. The second point was that contrary to what happens during a war, infrastructure were not destroyed by COVID-19. So the economic background, the economic basis could enable a recovery and a rapid one. Not for all sectors, but for some sectors, it could be very rapid because all the infrastructure were still in place. Why to increase our exposure to cyclicals? For the same reason, we thought that people would save money during the period of COVID-19 and then would have the opportunity to splash it out. And why the US? Well, I think I touched about it. It was a bet about a surge in employment after the surge in sub-employment during the crisis. So this is what we did in March. We are in the process of changing things now because first the ideas were implemented have performed well, especially our decision to raise our exposure to the US and to raise our exposure to credit and cyclicals. But now we think it's high time we try to reduce or to be careful on the exposure to banks. A lot of sectors, not all of them once again, but in the corporates or sovereigns, agencies, and so on, will have the ability to avoid, for those who are in a position to issue bonds, so the biggest companies, the biggest agencies, they will be in a position to avoid the economical consequences of the COVID-19 and the economic crisis that is still going on. This will be harder for some banks because their balance sheets will have to absorb loan losses and a higher cost of risk at the end. So for us, banks might be the next area of cautiousness for the markets. We have time to implement this view, but to give you a color of what we are trying to do for the time being, this is the correct approach for us, and this is what we are trying to do. As I told you a few seconds ago, now, given the liquidity we observe, the lack of liquidity we have on the market, to implement or to cut a strategy can take time if you want to build up real positions. There was also a question about the kind of companies we do like at Mirova or the kind of bonds we do like at Mirova. And if we can move on to the following slide, this is not the only examples we can find out on the market, but as I told you, we are going through an economical and environmental transition, and the companies that were adapted to the economy of the 20th and 19th century might not be the companies that are the firms that will be adapted to the future economy. So what we try to do at Mirova, we have 11 ESG analysts focusing only on ESG, and they try to identify which company can really be adapted to the low carbon economy. And here you have an example with a company from Denmark, Ørsted, which is ranked the most sustainable company in the world. We have it in the portfolio for several months and even more. And the idea is that we like this kind of companies which are transitioning very rapidly. This means, if our analysis is correct, that at the beginning for this kind of transitions, those companies will have to invest a lot of money and to fund those investments, those capex. But we think this is worth the price, because what we observe is that once they are engaged into this transition, their credit and economical profile improves pretty rapidly, even after the huge amounts of capex they have done. So this is Ørsted. This is a classical, traditional, very easy example, but we have plenty of them within our portfolio, and we think this is where the value is at Mirova, trying to find out which issuers will be adapted to the future economy. They might not be found out in the spectrum of companies that were adapted to the former economy. And I hope it was clear on that. I also had a question about, yes, sorry.
No. Please feel free to finish. I just preparing some questions if you guys are ready.
Okay, I was thinking about what you told me about which companies are not adapted or will suffer in the coming months.
That's also one of the questions, so feel free to answer.
Oh, okay. Okay. No, but I will answer the questions when they arrive. In this case, it's okay.
No, feel free to answer this one, because I wanted to have it at some point.
I don't want to reveal any secret of Mirova, but there is one sector which we think is really, really in a much horrible situation that everybody is thinking, is airlines company. Nobody should be surprised if I mention airlines as being amongst the sectors that are among the losers of this crisis, but we think this COVID-19 crisis for the airlines sector might result in a long-term crisis, even in a case where the COVID-19 disappears or if a vaccine is found. The way we will organize our travels might change a lot over the coming months and years. So this was just one sector which we think is not very well placed, in addition to, of course, some sectors in the energy production.
Thank you so much for your answer on this one. And I would like to then move on to some questions maybe. And one of the questions that I would like to ask, maybe Christophe, you could elaborate on this one. Since both of you mentioned that your view is that the US economy bounces back much more rapidly than European markets and European economy, why do you think this is? What is the main driver of this phenomenon?
Actually, what I've said is that the US economy is more flexible than Europe. This crisis is quite unusual, because usually on the previous crisis, any kind of crisis, it comes from somewhere and then it goes 3 months, 6 months and touch some other area. So historically, the US drove a lot of the crisis, 08, or the tech crisis. It was a lot of driven by the US, and then impact with a gap and delay a bit more Europe and the rest of the world. This time it's actually it's started by China, then Europe, and then the US. So I'm not sure that the US, obviously the graph we saw about the indicator, advanced indicator of that Citibank showing the US rebounding very quickly. So for sure that the US is more flexible, but we may have a bit less of a gap than we used to have in the past, where we had this, for example, in 2008, you have the financial crisis linked to the real estate market in the US and then impacted the rest of the world with a delay. That now is probably slightly different. So I guess the recovery of the economy should be more in sync, which creates some risk as well, because maybe we will realize that there's so much money sent into the market that it was, because it was so difficult to evaluate what are the risk, and then that's you could have the central bank taking a bit of the money back a bit earlier than what the market think, and that would create some stress, obviously, on the fixed income market. We're not there yet, and some inflation. So we're not there yet, but that could be one possible scenario down the road. If the rebound is quicker than expected, central bank will have to move. They definitely will prefer to be behind the curve than too early, but
Yes.
that's still a risk.
Thank you so much. I have a question to Bertrand. You mentioned in the beginning of the presentation, when we were looking at our macroeconomic overview chart, that at Mirova you have a different consideration on when you label an economy advanced economies. I think this could be very interesting to elaborate. Why do you split this advanced economies into separate sections?
Okay, well, for the reasons I already mentioned, partly. First is the differences between the flexibility of the US economy, which Christophe just talked about, and that of the Europe, of course, so everybody is aware of that. And the fact is that we regard the long-term trends as being a sort of divergence between the US and Europe. From World War II, from the end of World War II to, let's say, the beginning of Mr. Bush Jr. mandate, Europe was a sort of replication of the US economy, smaller, slower, and more protective, but more or less it was the same thing, and the rest of the world was totally different. We now consider that it's diverging, and this is to last for maybe several years or several decades. This is the first point. The second point is that it's just like as if we had built up a new planet called China. When I started and when Christophe started his work, Chinese economy was counting for nothing. It was something I had no look at the beginning of my career, neither Christophe, I presume. And now all of a sudden it's the first or second economy, depending on the way you measure it. And this has changed all the equilibrium and the balance on how global trade is done and the access to resources, natural resources. Now China has put in place several things very wisely, very patiently. This is nice to them, but this is changing the way you can call the developed economy landscape, because you have a new planet, a third player called China, and it is by definition creating a sort of discrepancy between Europe and the United States of America. So this is basically it. I hope it was clear, but
yes,
I don't think the developed world can be dubbed as developed world as if it was one block like before. It's no longer the case, in my opinion.
I have another question to both of you, and the question is, when we talk about investing in the second part of the year, I know we mentioned a couple of trends maybe, and Christophe, you also went into a little bit of detail, but could you both identify some places where you see opportunity that could be exactly the opposite case that with airlines? Maybe do you see some change into a shift into technology or investing in ESG? where do you think maybe ESG going from now on?
Yeah, definitely ESG is more and more a subject that everybody is taking into account. So, and we've seen the impact on performance as well, even more clearly, more recently than it has been in any kind of period that we can take over the long term. So that's definitely a big subject, and it will our conviction is that it's gonna be increased as a subject, and not only because it's important, but because it's going to provide as well interesting return profile, and at least it's going to be painful for the company that are not following this kind of criteria down the road. So that's an important point, as you mentioned, that is taking into account, and we introduce that in our investment process, in our interaction with managers. And we're using our leverage that we have. We have 40 billion of assets that we 80% of that is delegated to manager external. So we use this leverage to improve the way they introduce ESG criteria in the way they manage money. Then on the opportunity side of things, I mean, there is something that we monitor very quickly. Is the rotation into a slightly more cyclical theme, because we've seen that the huge gap of first performance and then valuation in the market between what is quality or tech versus what is low quality or value or cyclical. And we started in and most of your blend manager, the one that are still style agnostic, started to move a bit more on the industrial style cyclical. Still some kind of high quality kind of names, but we've seen them moving a bit in the banks as well, in order to take into consideration this valuation that they consider attractive, as long as we consider that we don't have a second wave of negative news and negative a second wave of negative growth in the economy, or where in that case all bets will be off there. But that's where we see slightly changing portfolios right now.
Thank you. Maybe if we have time for another question. Bertrand, you mentioned in the beginning of our presentation and conference call that you saw some great resilience of Africa, and I find this very interesting because I read a couple of reports that actually were anticipating the entire opposite situation happening. What's your view on this?
Not sure to have understood the question regarding the opposite view. Sorry for that, Liliana.
Sorry, so my question is that in the beginning we mentioned that we saw great resilience of Africa when it reacted to the COVID-19 crisis. And my question is, what is your view on this?
Well, first, I wouldn't say resilience per se, but a greater resilience than what everybody was thinking at the beginning of the epidemics. I don't know if you remember. Everybody exactly. Everybody was talking about a catastrophe, and finally, African countries have dealt with the problem in a way that proved pretty efficient, given the fragility of some areas of the continent, and it was important to some extent to us to show that, well, Christophe talked about demographics and the fund of Schroders, our competitors. Demographics, when you look at the figures for demographics for the coming century, provided by the United Nations, for example, most of the rise in global population comes from Africa, finally, with some countries like Niger, Ethiopia, really having their population skyrocketing over the coming decades. And we think the COVID-19 was an indication that, okay, Africa will not solve all its problems, economical problems, immediately, but at the very least, that to to some extent, some of their states, some of their public authorities, and the population per se, as the means with which to really start something new. I'm not sure, this is not my job to say that they will have a 15% GDP growth, every year, but I'm sure they have pockets of growth in Africa for the coming decades. And I think the COVID-19 has illustrated that. It's not a proof, it's just an illustration, but it was a positive sign.
Thank you. I think this was something that is very interesting, and it was not discussed on many platforms. So I wanted just to bring this part of the word up as well. With this last question, I would like to thank both of our presenters and our audience that they joined today's conference call with RankiaPro Europe. And I believe that it was very interesting, and I hope that both of our presenters could shed some light on some key ideas. Again, I would like to thank all of you for attending, and until our next conference call from September, see you soon, and I wish everyone a happy summer and great holidays. Thank you, everyone.
Thank you, everyone. Thank you. Have a good day.
Thank you.
Bye.
Thank you.